Okay, let's talk more about all of this and that wide-ranging economic impact with Greg Daco. He's EY-Parthenon chief economist. Greg, it's great to see you. I'm going to start very simply here. What happened? What happened to the numbers that we thought we were going to see and a little bit more relief that we thought we were going to see in the CPI print?
Yeah, I think what we saw today was that inflation has come off the boil, but it's still simmering, and importantly, it's still broad-based. My eyes are going to be laser-focused going forward on the core CPI momentum, and a 0.6 print month over month is not the type of reading that the Fed wants to see as evidence of cooling inflation. This was a reading that was disappointing. Broad-based inflationary pressures led by shelter costs, as you just mentioned, with this pricing on the housing front still very present, as well as pricing pressures on the medical care front, where supply shortages are probably influencing prices to the upside. That is not the type of reading the Fed wants to see. This type of reading will push the Fed to act more forcefully, as it really wants to see compelling evidence that inflation is coming down. So 75 basis points, I think, is a guaranteed right now for the September meeting. But we have to look towards the back end of the year and into 2023. If inflation doesn't come off, the Fed will continue to act with determination to try to regain control over inflation.
Greg, looking at some of these categories here, the unfortunate thing is, too, that even if we look at the back half of the year, I mean, we're in the back half of the year. Let's think about that, number one. But number two, getting into some of the categories that actually did see declines, they're still set to go up towards the back half of the year. I think about airline fares, where there's still so much demand, even among the leisure travelers, that the airline operators have themselves said that they're going to continue to try and navigate this period with the best pricing possible that helps them sustain their operations as well. And so, I mean, even in categories that we did see declines in for August, it still seems like there's a headwind that could potentially still rear its head once again later on this year.
That's absolutely right. We're in a world that is rebalancing, and businesses are having to navigate this uncertainty where supply and demand are still unbalanced. So what we're seeing and hearing from a lot of the clients we talk to, the executives we talk to here at EY, is that we're seeing some desires to keep prices elevated. That prevents significant downward pressure on prices and on inflation. So as we look into the end of the year and into 2023, I think we should be prepared to be in an environment where we have persistently elevated inflation, and it will require some pain, as Powell has said, to regain control over inflation. Some pain in the form of reduced business activity, reduced demand, reduced hiring, potentially some increases in the unemployment rate to regain control over inflation at this stage. It's becoming increasingly evident that without a slowdown in demand, we're not going to see an easing of inflationary dynamics. And as we know, inflation erodes consumer purchasing power and forces people to dip into their savings and to use more credit to offset that burden of high inflation.
You know what's really fascinating to me, Greg, is that you're talking about that consumer demand. You mentioned supply chain earlier. I mean, we've been hearing from company after company that now has swung from shortages to surpluses, right? It's especially acute in certain industries, right? We've saw huge inventory builds at many retailers. We've started to hear from many of the semiconductor makers that they are now building up too much supply because they are seeing less demand from their clients. So is there just such enormous demand out there that it's sopping up what is now an increase in supply over last year?
No, I think what we're seeing is that there are imbalances in very specific sectors. If you look at the goods sector, for instance, we're not seeing companies that are essentially slashing prices on a broad basis. What they're doing is essentially trying to target their discounts in a way that continues to protect their margins. Because there's so much uncertainty as to the future demand, they don't want to slash prices for everything. So we're seeing the stickiness on the pricing front, not increasing prices anymore, but being very careful and judicious as to how many cuts there are. And we're seeing the same thing on the labor front, which I think is a key source of the ongoing inflationary pressures, whereby employers are essentially being very careful as to how much they address their talent pool and not laying off excessively because they know that the value and the cost of labor has increased. That continues to maintain upward pressure on wages. Even if wage inflation may cool, the wage levels are still remaining high, and that's what we're seeing on the prices front. prices are not falling rapidly. Even used car prices this month only fell a tenth. There are expectations that these would fall much faster in the coming months, but so far we haven't seen that turnaround.
75 basis points largely expected at the next meeting. But then what? And is that what the markets are thinking about this morning?
Absolutely. I mean, markets are really not so much focused anymore on September. It seems like a 75 basis point rate hike is locked in, given prior communication by Fed Chair Powell and by other policymakers. They didn't push back against market pricing for 75 basis points at the upcoming meeting next week. I think all eyes will now be focused on what happens in November, in December. The new trajectory is likely to be 50 basis points in November, 25 in December, as there are some hints that policymakers want to ease up on the pace of tightening now that we will likely have achieved a restrictive monetary policy stance. But if we continue to see prints like this, very hot prints, especially in terms of core CPI momentum on a month-to-month basis, that will push the Fed to press harder on the policy brakes. And perhaps it might want to hold the federal funds rate at a higher level through 2023, despite the high likelihood of a recession in the U.S. economy. That's going to be the key focus right now on markets, is how high the Fed goes and whether and how long it holds. The Fed has set very high bar in terms of holding rates for the foreseeable future.
Does that mean, Greg, 75 basis points, not just in September, but beyond?
Potentially. I think the Fed is pretty much open to this idea that it will need to tighten faster if inflation remains stickier than expected. We've seen Powell admit that he is willing to change his mind if the data does not come in line with the Fed's expectations, the Fed's forecast. There is no preset path, I think, at this stage from a Fed's perspective in terms of easing up on the pace of tightening. So we could very well see some further large rate hikes in the coming months, especially if inflation proves stickier than anticipated. And you've seen in most recent communication from Fed policymakers that they want to avoid the errors of the past. Premature monetary policy easing is not something that they want to encounter in this tightening cycle. They want to avoid the errors of the past in the 1970s, where monetary policy swung wildly and inflation expectations became unanchored and we moved into a higher inflation regime.
All right, major averages this morning reflecting an unwelcome surprise. EY-Parthenon Chief Economist Greg Daco, thanks so much for joining us.
Thank you.